And we are live party people on the internet. What's going on? Happy Tuesday, Monday feeling Tuesday to you. I don't quite have my buttons squared away yet, but that is going to be for the next broadcast. So not as much animation today, but it's sort of a big topic. And looking at just like some of the comments today, I posted something on Facebook about like if you still think that there's this big crash coming and that this doomsday is on its way, you're forgetting about one important component to that. And that component is the Fed. And what you have to recognize about the Fed is that they are in a position now where whatever it is on paper they're supposed to be doing, that's not what they're doing. So, what is it that they're doing? What are they actually doing? Are they creating a facade for, you know, a backdrop or backstop for government spending? Are they just trying to keep interest rates low so that the government can service its debt for as long as possible before we finally get to a collision course situation where they go, okay, guess what? Can't pay you back. See, I don't think that'll ever happen. I think they will inflate into infinity. They'll never like have that moment where go, we can't do this anymore. Because unfortunately, it's not in the Constitution. It's not built in that the politicians have to be fiscally responsible. They don't. Imagine if you hired 535 people to look after your credit and your money. They spend all your money, and now they're running up new credit card bills every single month. That's what's happening. What I just told you there, that was not a fake situation. That is what's happening. And so, unfortunately, you have to have lower interest rates because now we've got this debt to service. The country has to make a payment, a monthly payment, and they have to make that payment or they're in default, and it really sends a ripple, a terrible, terrible ripple. So that can't happen. That's the worst case scenario. So in order to pay the debt, what do? Issue new debt. Oh, this payment's due. We don't have the money. Go get more money by issuing new debt, getting another credit card, pay that debt. Now that new payment goes onto the list for next month. That's what they're doing. And this has been going on for a long time. And that's why the debt continues to grow, because we're using debt to pay the bills. It's terrible. It's literally what people do right before they file bankruptcy. Like it's something that individuals do when they are in really bad financial situations and they keep borrowing until they can't borrow anymore. And that's usually when the music stops and BK happens. The US should be able to borrow essentially forever, right? Unless there's a default. Then you have mega issues. So they won't allow that. It increases the likelihood for default if interest rates are high. So the Fed, 100% for sure, regardless of whatever else they're saying, regardless of whatever else they're doing, regardless of whatever they're supposed to be doing, 100% for sure, the Fed wants to keep interest rates lower. A lot of people believe that the Fed is going to cause a real estate crash because that would be deflationary, prices come down, that would help with inflation. And you could say that in one sense, because we have to look through the lens of everything just being essentially currency. Like we're talking about this in dollars versus francs or Ethereums or whatever. But it's not actually one of their goals. Because remember, not only is inflation an issue, there's also politics. So what should the Fed do? If the Fed really wanted to cleanse this, you would just get out of the way. Just stop doing everything. Sit on your hands for 2 years, and then we'll get where we need to go. But it's going to be ugly, and it could be slow and painful and terrible. And politicians, that doesn't work for them. It doesn't. That doesn't work. So there's politics behind this as well. And those things are definitely coming into play. Now, I'm not saying that the market can't go down. I'm not saying that there won't be bad days. I'm not saying there won't be bad pockets. I'm not saying there won't be certain markets that get really, really, really hammered. Totally, entirely possible. But what I will say is the likelihood, the possibility of some big crash just isn't there. Unless there's something we haven't seen yet. If something new happens and that changes things, I'll be the first to admit it. Hey, this new thing, that changes things. We don't have one of those yet. Some people are saying that, well, a lot of these second homes are going to get capitulated for this reason or that reason, or people were borrowing money from this to buy real estate in cash. And that's another thing that's there's lots of those talks. Been through these cycles multiple times. It's the same soundtrack every time. It sounds the exact same. This doesn't sound any different than in previous ones. When we got hit with the crash, that was like a blind side. That was like a sucker punch. And that's what crashes feel like. This feels like, a situation where rates have gone up very quickly. It has definitely caused an issue, but I do have good news on that front too. We're going to talk about interest rates today. We're going to talk about oil. We're going to talk about inventory. We're going to talk about all these things. This is the real star I should have up. Rising interest rates may blow up the federal budget. That was written on Friday. And this is really, really good to take a look at, just like looking at the budget and essentially the expenses, what's going on, what's happening, what higher interest rates do to these macroeconomic circumstances. This is a good read for that. If you're not like fluent on that, if that doesn't make sense to you, check this out and see if this helps, because it's much more important to the country, to the macroeconomic circumstances of the government, to keep interest rates low. So all I was saying is the first opportunity, they will ease. They will either lower interest rates, buy bonds. Do you know how easy it would be for the Fed to make mortgage rates drop like a rock? Yeah, easy it would be. And by the way, rates have been going down. We'll take a look at those right now. Why not? This is actually mortgage bonds or mortgage-backed securities, whatever you want to call it. And we've got a nice uptrend going here. Really, really nice. Really, really good-looking channel. That's what you want to see. And this is one of the things that we haven't really been able to see for too long a period of time. We had one that we were working on, what was that, a month, as in late May, kinda, but it ended up being more of an ascending triangle. This is a really nice flow here. A nice channel, higher channel. It's not super aggressive. It's not some V. And there's back and forth. We're touching the top and the bottom of the channel, but we're busting through resistance, guys. This is usually the sign that there's big buyers involved. Is the Fed already in here? I don't know. Interest rates are great, though. We're seeing stuff in the low fours, mid fours, FHA, VA, low fives, conventionals back. ARMs locked a jumbo ARM today at 4.2%. Okay. So a jumbo purchase, 4.2% on a 7/6 ARM. The rates are much better than what people. The fact I talked to a potential buyer this morning, and he was like, "Yeah, so we've been hearing that the Fed has raised rates, and we're trying to calculate what we think our payments are going to be, and we're using 6.5%." I'm like, "Whoa, what are you doing? 6.5%?" It's like, "Yeah, we just kind of did that math on our own. You guys are going to get more like 4.5%." So I think the fear, we may be underestimating how overdone the fear is, because everyone heard when the Fed said we're raising rates 0.75%, everyone heard that rates went up. That day, mortgage rates actually dropped like 0.25%. They are not the same. They're not correlated. So, and in fact, sometimes can be exact opposites. They can run in lockstep. They're not correlated. So we can't look at one and expect the other. But right now, I mean, look at this. I mean, we touch resistance here, right? Peel all the way back to the channel right here. And then we bust through resistance, close above it, bust through resistance now, close above it again. I mean, we've had multiple days in a row now, multiple business days in a row. We've closed above resistance, challenged or closed above resistance. I mean, that is really, really strong. That makes me feel like we're going to continue this march, at least for the time being. It's a very good sign. Very, very good sign. And P.S., this resistance right here was major. And we just sort of stepped over that guy like it was a rock, an unsteady rock in a creek. We just stepped right over that thing. So interest rate wise, it looks good. Now, we're not seeing massive movements in positive direction, but that's okay. We're seeing things go in the right direction. That's good. That is good. Let's go back here. Okay. Common, simple, obvious stuff. Housing shortage starting to ease. Remember, we were complaining about housing shortage. Now everyone says there's all this inventory. It's really not as bad as people make it out to be. But what's caused this issue is the trajectory once again. And just a quick look here at this. This is Altos research. Great stuff. And you can see the market action index, which was in the high 90s at one point this year. the very early part of the year, is now down to 74. It's the lowest we've seen it in a while. Last month was at 82. So you're definitely seeing the pendulum swinging towards the buyers. Still very much considered a strong seller's market. So what I like to look at here, there's a bunch of data in here. I'm not going to go through all of it, but inventory, we're going to look at two things: inventory and price per square foot. Inventory, so you could see here on the 7-day average, which is moving quicker, the dotted line, we've got a spike there. Inventory spike in there. And that's what has people worried. If this trajectory continues, there'll be 1 million houses on the market by the middle of next year. We know these things don't happen like that, right? There's ebbs and flows, ups and downs. And just for perspective purposes, right now we are at inventory levels that are consistent with around November 2019. So if you remember where inventory was, if you remember the feel of the market at that point, it felt pretty tight, not crazy tight, but it was tight and had been for years. Rates were, good. And it's kind of a similar time to now, except for we were on the descend. Inventory was getting chewed up, whereas now it's not at that same pace to where we're actually seeing it descend. We're still ascending. So it's definitely more inventory. Again, good for buyers, good for buyers, good for buyers. If you're the type of buyer who just wants to buy when rates are low and it feels very safe, you'll be buying with everybody else, just like the last 2 years. If you want to buy in a market where it isn't a frenzy, or you may have more options, this is the kind of market to buy in. But you don't get the ultra low interest rates that we had, when we were in the twos. All right, now here's price per square foot. And I've tracked this for such a long time. You see, we have these occasional dips below the 90-day average. And right now we're in one, but still very close. The 7-day average and the 90-day average, still very close. $685 a square foot on the low side. That's for the 7-day average. And that's for detached homes in San Diego. I'm not looking at the condo data here, but you can see still, it's rounding off. Price per square foot is rounding off after a very long multi-year, solid, slow ascension. Really, really, really good. Really, really good looking. It appears to be rounding off. Does that mean prices are coming down? Yeah, that's what that means. It means prices are coming down. Are they crashing? No. Are they moving in the right direction for buyers? Yes. We did see bonds today flash some stuff, by the way. I am trying to get good with StreamYard. So if you can post a comment. Let me see if I can see it. You're supposed to be able to pull these up and look at them on here, but I don't know. We'll see. Bonds flash this warning sign. The yield curve, the 10 and the 2-year inverted, meaning that the 2-year is now higher than the 10-year. So that means that the long-term prognosis for rates is lower. That just kind of, this is hey, recession's coming. Things are bad. People are wanting to buy the 10-year at a lower rate so they can lock it in than to buy the 2-year at a higher rate and then roll it over 5 times over the next 10 years. That's kind of what the logic is behind that. So more people are fleeing towards safety. But for me, just the fact that they're buying bonds is great. That's tremendous. Great. Buy the bonds. We've seen the appetite for bonds increase, just like we were discussing over here in the mortgage bond chart. Look at that. It's just a beautiful rising channel that we have going on right here. And yes, we've met resistance. Yes, we've had some bad wicks on the north side of things, but we just keep moving higher. Keep moving higher. Lots of green candles in a row. It's not crazy. We don't have a God candle sticking out over here or anything, but we're moving in the right direction. It's slow and steady, and we're piercing resistance consistently. This is good. I'm telling you, I think the big bond buyers might be here. They very well might be here because they're buying the 10-year. They're buying these mortgage bonds, which are 30 years. Big bond buyers look like they're back. That is really, really good. If I'm right about that, and we've seen the highest interest rates we're going to see, assuming that we don't have any really bad inflation data that comes out, that could hurt. But assuming that we don't have any more terrible, huge surprises on the inflation front, we may have seen the highest rates. That could be behind us. That's possible. Oil, if you didn't notice today, really took a tumble. Actually, I had this pulled up. and I was trying to, my computer had to restart. Sorry, it's one of those things. So that's the oil chart right there. Yikes. Look at this. 6 a.m. So 30 minutes before the market opens, they couldn't wait. They wanted to front run the market, get the heck out of this thing, and they got out. And we went from, $108 and really kind of bottomed out in the 97 range, 97, 98 range. So from, 108 to 97, 98, $10, 10%. That was the loss for the day on oil. Oil, what's great about oil is it is a truth serum, and it will tell you what the macroeconomic picture looks like whenever there isn't like mad manipulation going on. This is why we shorted oil when it spiked to 130. The first time I didn't get the second spike. I got the first one. So that was nice. Rang the register on that one. I don't like to like short and to play the options game with oil as much as I like to just go long the USO when it goes lower. But in this case, it's just too easy. When oil spikes like that, it always comes back. It can't sustain at those prices. People just won't use it. It's one of the most amazing, like what do you call that? When it checks and balances, it watches over itself. Essentially, it effectuates itself, because if it goes too high, then people won't use it. So then the price has to come down. If it goes down low enough, then people will use it. The price has to come back up. I'm having a brain fart on the word I want to use for that right now. But anyway, so below $100. Cool. Here's interesting. Citi says that they could fall to 65 in a recession. Oh, come on, baby. Bring it on. I will be back in the oil trade, and I'll be backing up the truck. Listen, I'll let you know. I don't do a lot of trading. This isn't a trading channel. But there's times when there's easy money to be made in the market. Let's make it. Why not? Could fall to $65. It's true. I've looked at the chart. There's definitely a lot of support at 65. There's support along the way between here and there. I don't know if we'll go all the way to 65 or not. But if you do see 65, I remember when we had $40 a barrel, $45 a barrel. That's when I first started buying for the oil trade last time. That was a no-brainer. And if it gets anywhere near that again, we'll start accumulating for sure. What was I going to show you on this too? Oh, the Dow. So that's another thing we can't not look at this too. It looks like big money's buying right now. Let's just put it that way. So stocks stage big comeback Tuesday. And if you weren't paying attention during the day and you just saw, the data at the end of the day, and I'm like, well, the Dow was down 129 points, and the S&P was up like 0.2 or whatever it was. What was the S&P up? 6 points, 0.16%. But look at what happened throughout the day. Okay, we gapped down huge, and then we just sell. At one point, we were down over 700 points today. And then look what happened. Rounded bottom, buyers come in, and they just didn't go away. What's going on? What is going on with that? It's interesting, isn't it? Look at the day before. Kind of a similar looking chart, isn't it? Or here on the 5-minute. Similar looking chart where we get, the big sell off, and then buyers come in and don't go away. So it looks like there's some pretty big moves being made here to the long side. Isn't that weird right now? Especially if you look at the overall channel. I mean, if I zoom this thing out, I've got the channels in here. That's what it looks like. Not pretty. Not pretty at all. But then you look down here at these wicks, and it does look kind of bullish. Maybe we're headed to the top of the channel. I don't know. But it seems like there's a lot of buying activity happening right now. I wanted to mention this. So in other words, I guess my point on that was, it seems like there's big money entering the market here. It could be for a short period of time. You never know, but it definitely, and I'm not saying I'm bullish on stocks or anything like that, but it's interesting to know what's going on. I'd rather look at this stuff and see what's actually happening and just say it out loud, see it, digest it, try to make decisions based on that, instead of going, oh, the stock market's screwed, blah, 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 go over here and poke my head in the sand. That's exactly what they want you to do. Keep seeing everything for what it is. Look at it, see it for what it is. Don't lie to yourself about it. Don't let someone else lie to you about it. This is what's happening. This is what it is. I don't like the fact that the Fed has manipulated the market and put us in a position where we're literally kicking the debt can down the road. It's terrible, but it is what's happening. I can't change that. So I need to see what it is and try to make a guess about what's going to happen next. That's all we're doing here. Luxury car buyers shell out more than ever with car payments that look more like mortgage payments. I've seen these $1,000+ a month car payments. It is something to avoid. Cars have gotten really expensive, and I hope that all sorts itself out. That's seriously nuts. That's how we knew that we were in hyperinflation, when used cars were selling for more. My 7-year-old Tesla was worth more. I bought it 3 years ago. Was worth more than what I had paid for it 3 years later. That's silly. That tells you we're in hyperinflation. So we need that to chill out. This is good for if cars are not going to, if there's not going to be a frenzy for cars anymore, that would be good. We need that to normalize. But the point of me bringing this up is just like, be careful that car payment, that massive car payment. So many people have them, and man, it can be a real bummer sometimes. If you do have a huge car payment, though, here's a tip. When you go to buy a house, if you're not approved where you want to be, see if you can refinance the car. If you can refinance a big payment off of a car and go from 1,000 to 700 or something like that, you might increase your pre-approval by 50, 75 grand or something like that. So, see what you can do if it comes to that, to help boost your pre-approval. Okay, we looked at rates, up 23 basis points today. Nice channeling higher going on here right now. I really, really like it so far. Been dead on with this as far as what's happening in the interest rate market, and to expect rates to continue to improve. Let's see, I was going to check this. Yeah, it's still not working. I need to figure out something with these. All these comments aren't working. I'm still new to the StreamYard world, y'all. I don't have the same tools I have on the other spot. Let's see. But while we have the time, let's go through some of these. Yeah, median list price dipping a little bit. I don't really like those. Price per square foot, we talked about that. Average days on market ticking up, but not by a lot, just slowly ticking up. That's okay. It's going to happen. Demand has decreased. People think rates are 6.5%. How would they know if they didn't inquire? We got to tell them. Median days on market, don't care. Price decreases. This is interesting. This one is really interesting. From 8% back in the middle of March to 38%. So seeing a lot of price decreases. This is good. This is sellers figuring it out. It takes some time for sellers to figure out the market's changed. It just does. And we're in that process right now. So that's good. Relisteds have ticked up a little bit. Inventory is on that slow rise right there. Rent is still really bad. Market action index is really taking a fall. I mean, if we look back, middle of March, we were at 91, 92. Now we're at 74. So things really starting to swing in the buyer's favor. I can't tell you enough that, in situations like this, these are the times that buyers look back on and go, oh man, there was that moment right there where we could have bought. Just think about this. If somebody bought in 2020 or 2021 and they were house poor as a result. So let's say, they were trying to, they were buying in whatever, anytime in 2020 or 2021, and they were getting these really low rates, but they were at the very top of their budget. And they're like, gosh, should we pull the trigger on this? Oh man, we're going to be house poor if we buy this place. Well, that was a risky move with rates that low. There was no reprieve. You were just jumping into the deep end. Look what happened. It worked out for you really, really well. Home has equity. You've got a great rate. Hopefully you're getting paid more. You're getting some increases in your pay as time goes on. And it's, helping to ease the gap. Today, if you were to buy if you were a buyer who's sitting there considering that, should I be house poor? Should I rent? You actually have a lot more room for reprieve because rates can come down, and they can come down quite a bit. If you're buying something in the 5s for conventional or 4s for FHA, VA, and we get back into the 3s and the 2s, you'd be able to refinance and save a fortune. People who bought in 2020 and 2021 didn't have that. Their rate was already as low as it was going to get. So it's actually easier to justify it today, especially since you don't have the frenzy. You actually have a little bit more inventory to choose from. And you don't have a frenzy of 30 offers to try to fight through when you find something you like. So for people who are asking me, it was my buddy Evan who asked me this earlier. He said, should buyers like me wait, something like that, for lower rates? He said, so those of us looking to buy should perhaps wait it out for a better interest rate. That was what he said. And I basically just said, I'd rather buy in more of a buyer's market and then just refi to the lower rates when they come. Because if you wait for the lower rates, who knows where prices will be at by then? But for sure, demand will be increased. So if prices are the same and demand is increased, although it looks like, hey, I'm getting the lower payment, you would have had the lower payment either way. So, you're better off to buy when circumstances are good for buyers, to be a buyer. Better off to sell when circumstances are good, to be a seller. And right now, it's still a seller's market, but it's definitely changing. It's definitely changing. If you have that primo inventory, it's still primo. You're still golden. But if you don't, if you have one of those homes that's not primo inventory, if you have those homes that's not dialed in, dated, needs love, not in a good location, those kinds of things, those homes are not just going to fly off the market now. You could hear crickets for weeks or months. So it's just changed. Listen to your professional, listen to your agent, hire an agent, listen to them. If you don't like what they're saying or you think they're dumb or something, fire them and hire someone else. But don't have someone representing you who you don't trust to listen to them. Listen to them. Okay? That's huge and most important advice. Because if an agent is good, if they are worth it, then you should be listening to them. If you don't think they're worth it, fire them. Hire someone else that you do trust, that you do believe in. But whatever you do, listen to the person that you've hired, unless you fire them. All right, guys, that's it for me today. Okay, cool. I see this is working. Nice. Let's see what happens if I bring it up. Slim Dog. So it's maybe working through YouTube. Maybe it's not working through the other platforms. I'm not sure. I'm trying to figure out the StreamYard deal, it's an amazing platform, guys. For anyone who's doing videos out there, look at StreamYard. It's really, really neat. I'm going to call it a day. If you got, here's the thing. One more thing. If you guys need me, I'm here. I know I ain't going nowhere. I know what's going on. I've been here before. Call me, text me, shoot me an email. If you need a free loan quote, you want to buy, you want to refi, I will be here for you. I will take care of you. We'll make sure you get the best deal you can possibly get. Have a great day. Take care.